Hello, welcome to my retirement roadmap. This video is about spending capacity using Income Lab software. So I'm going to do my best to walk through this demonstration, make this hopefully easy to understand and see how powerful this is. The spending capacity is for people in retirement. This is basically a sample that client that I prepared, that I put together, and I'm just going to walk through all this. I tried to make the household fairly simple and what's going on, even though that's definitely not representative of everyone. Everybody's situation is a little bit different. First of all, I do want to say that you can see that the current balance is $1 million even. So obviously, I wanted to choose a nice round number. Please don't read too much into that because everybody's situation is different. I've seen situations where a household with, say, $3.5, $4 million, that was just not going to be enough. That's the investments that they have saved. That just wasn't going to be enough. I've seen households with less than 200,000 where they are in top shape. They have nothing to worry about. So it just depends on what everybody is. So I wanted to make sure people understand that I'm not saying $1 million is necessary for anything. It's just what I use to demonstrate this software. Okay, so let's just go in and take a look at this as I walk through and lay the groundwork for how this is. So we have actually up here, we have Mary and Bob. Okay, they are married, filing jointly, basically. And Mary was born in February of 1961, 65 years old. Bob was born in February of 1956, 70 years old. So obviously I chose those uh, dates for a reason, and we'll kind of walk through that. Also, this couple is in the state of California. I'm in the state of California, that's what I used. And also, they are both retired. Now, what does that mean? It means that the software says, hey, listen, we can go in and use their retirement accounts to draw out of, that they're available. That's what that means, that they're retired. Okay, so now let's go and look at their assets right here. So we have joint investments for them, $100,000 of taxable. This is in a brokerage account. Um, so I just wanted to show you as well on that they half of that is the cost basis is half of that. So when they withdraw it, that's what's going to be used to determine the taxability, and also this is showing how it's going through and set up for us. Now, we are using the risk-based defaults for these investments, and basically we're talking about 60% stock, which the default here has 50% in the total U.S. stock market. That's my favorite as an ETF, and then it has 10% international, and I like the ETF side of that too. So that's what's going on with that, and that will be the case for all of these investments as well. Just to keep things simple. Now, again, in reality, that's not the way it's going to be, but for our demo purposes, that works very well. Then Mary, she has a 401k, $500,000, and again, it's just the same, 60-40 portfolio. That's what we're using. Bob has an IRA. Again, it's all tax deferred. Again, so it's a traditional IRA, and his IRA is also the 60-40 that we talked about. So all going through there. In this scenario, we are not adding any annuities. Okay, so just keeping it simple. There's not an annuity. We are not having any bank accounts, and we're not also putting in other assets. We're really trying to keep this simple. Now we'll go over to Social Security. For this example, both are claiming Social Security. So Mary started claiming when she was 65, okay, just barely. And same with Bob, he just started claiming when he turned 70. And so Bob being The older person in the household, he did what we kind of advised, that he did wait until 70 to do his claiming. And they're also, by the way, in this scenario, this isn't about Social Security, but they also have the same primary insurance amount. Okay, so that's just walking through Social Security. We didn't have any other income that's coming out of that, keeping it simple. Okay, so we are going to then go back here. And I just want to show you, this is basically the dashboard for this plan. Starting this month, okay, so it's talking about right now, this household, the spending capacity is $7,570 per month. And that is net of taxes. Okay, it's a monthly amount. And it is a real amount, but we don't need to worry about that at this point for our dashboard. But $7,570 per month. That's what the software is saying that they can spend. Now, before we dive too much deeper into this, let's take a quick peek at the settings that are going on in this plan. Just wanted to show these. These are the advanced settings. Now, for some people, this is interesting, but right now, for taxes, we are using a pro rata portfolio withdrawal order. This gets a little bit advanced, but what it's saying is we're taking from the taxable, tax deferred, and tax free accounts pro rata. However, the typical convention is to go where you start with the taxable account first, you spend that down, then the tax deferred, and then your tax free or your Roth accounts. But in our scenario, we're just saying do it pro rata. In reality, not to go down too far down this explanation, but in reality, it's like you kind of set yourself up to do the taxable, tax deferred, and then tax free. That's the standard. But every year you look at it and do some serious tax planning to make sure you're doing in the current year, call it more tactical, what is the best for that current year. And then you can also do Roth conversions, but I'm not that's definitely in a different, more advanced demo for this software. Okay, so that just gives you an idea of how we're pulling the money out there. Social Security, we already covered. Medicare, we don't need to really look at that. Longevity settings for here, we're saying that this household, that they have above average life expectancy. Okay, so if you, we have Mary, we're saying above average, also Bob, and the plan length is 29.3 years. Okay, so that would make Bob 99.3 years old if he lives that long, and Mary would be 5 years younger than that. So that's basically the longevity settings for this plan. Now we can tweak those either way in the software, but we're just going with the defaults. Okay. For the legacy goal, what does that mean? We're not going to leave anything to anybody. and I hear that more and more. So some households would like to say, hey, I'd really like to leave a little bit of money for my family when I pass. But that right now we're just kind of saying, let's, the saying is die with zero type of thing. Now that's not the way this works, but it is. If we did put a legacy goal in there, it would work with that. The software would work with that to make that happen in its number that it's proposing. Okay, the income path. I think this is important. So the income path here is we are saying that this is a flat income path, which means every month would be exactly the same. Now we'll come back and I'm going to do a couple of changes to this because there's another income path which is age-based, which is if you've heard of the retirement smile, which means when you retire and you're younger, you're probably going to spend more money, and that's the way that works. You do spend more money, and as you age, you spend less and less, and then towards the end, you may increase spending because of healthcare issues. Okay, so that right now our income path is flat, which tends to be a more conservative approach, and our income settings, we are just saying what can I spend. That's that spending capacity that we're talking about. And here's another part here. We are using regime-based Monte Carlo. Okay, and I'm going to show just what that means here. I've got everything set up correctly. First of all, we'll talk about this is the traditional Monte Carlo. And that would be such that it would be applied across the entire plan. If you could see here, kind of try to remember this number. So the all cap U.S. all cap total U.S. stock market is 9.29%, and this rate is the real rate. So basically, for Monte Carlo, it was kind of historically you'd basically say we're talking about a real return in the total U.S. stock market of 9.29%. Okay, so that's Monte Carlo traditional. And another thing that's kind of interesting there when you scroll down here, inflation is at roughly 2.5%. That's what the Monte Carlo rates are. But I like to use the regime-based near term here, okay, which then is, you could see a big difference. It's 5.08%. And it's saying basically, like in the next 10 years, we're going to throttle back that return on the U.S. stock market and throttle it back to 5.08% for a real rate of return. So that means that 60-40 portfolio is not going to grow as much as under the Monte Carlo tradition. And I think this is important to know that we are looking at a conservative amount. And then here, inflation, you can see inflation over the next 10 years. This regime-based is projecting that inflation is higher than what we saw in the Monte Carlo traditional. Just wanted to lay that groundwork. And then let's go back to our plan here. Okay, so again, we're using the regime-based, which is more conservative, a more conservative approach at this point. All right. So again, we're coming back to $7,570. And then there are these guardrails in place. These are guardrails, and we'll kind of show those in the next part here, which we go over to the retirement stress test. Now, really like this part of the software. It takes a few minutes to kind of sort through and understand what it's talking about here. But basically it's saying, hey, listen, we've given you a number. Let's see how it would have worked in these financial situations that weren't all that great. And I was born in 1962. I lived through stagflation. I remember things very well, and that resonates with me. So let's just see what happens here in that scenario. Okay, and basically this plan starts right before that stagflation era. So it starts in April of 1968, and we're starting out the real numbers here, the and their levels. So it's saying, hey, listen, we are starting out at $7,667, and you're going to be able to keep that, and you'll actually, it's the real numbers, and you're going to be able to in 1986, right? Several years later, you're going to be able to bump up the amount that you can take out. Okay, we're going to add $1,682. So that works fine. And if you look down here below, you can see this is the portfolio. We started out at $1 million. Okay, and you can see during that crisis how it went and how that portfolio performed. Again, we're using the regime-based numbers, which are more conservative, and this holds up really well. Okay, so that's back to that's back here. Okay, on our spending capacity number, and we looked at the retirement stress test. $7,570 based on the Social Security that we've input and the investments that they have. That's where we are. Okay, I want to change one thing real quick, and that is we are going to change the income path here, we are changing it to age-based. So again, that means, hey, listen, we're gonna spend more money as we're younger, and as we age, we're gonna spend less. So let's see what happens there. Now you can see we're now up to $8,790 starting this month in our demo. And by the way, this month is March. The plan we're doing now is March of 2026 when I'm recording this. Now let's go and look at the. Okay, so again, this is less conservative. So because we're starting out with a higher number. So let's go see what happens in the retirement stress test. We're going to go back to that stagflation era. Okay. And you can see it's still kind of doing okay because we start out, the number is going to drop as we go along. Okay. Because we're spending less. We're on that smile. So we spend less. And then again, we pop up a little bit and we keep going. So even that number, because we're starting out higher, but we're going to lower it as we get older, it's still holding up. We don't have to decrease our spending. Okay. So I think this is helpful for people to kind of understand, and you can kind of see that, 1968 to 1980, for example, you're still doing well. We're down. We decrease every month, but it's okay. All right, so let's go back. I want to go back and make another adjustment and show here. We are going to now go into the advanced plan settings, and we will take the plan analysis. We are changing it from regime-based Monte Carlo to traditional Monte Carlo. And we're going to save that. And we'll go back to the dashboard. Okay. See how that jumped up to $10,300? Okay. That's because we're now saying, hey, listen, we're going with that higher number of expected returns and a lower rate of inflation. Now let's look at the retirement stress tests. We'll go over here. We are looking at the stagflation era. Okay. Aha. Okay. So what's happened on here? We are starting at a higher number, and also this is the smile as well. So we're starting out with a higher number because we've got higher expected returns in the stock market, and then we're also doing the smile, so that number will go down just because of the smile as we move out of our go-go years into the slow-go years, etc. So we're going along, and then we get to here, which is October of 1974. And the plan says, hey, listen, you need to take a pay cut. Things aren't, as rosy as we thought. So that goes down. We have another one here. Looks like April 1979. We cut again in March of 1980. We cut again. See, we had these drops as we go along in that stagflation era. And you can see also down here in the portfolio, it's going down. You can see that's why we're hitting those lower guardrails. And I know this sounds like, oh, that doesn't sound so good. But the reality is, in retirement, we're flexible. Okay, so we're like, oh yeah, the economy's in bad shape. We're naturally going to be making adjustments. So instead of going on a world cruise every year, or some European or visit some other continent type of cruise, one of those major bucket list items, we're going to be like, hey, listen, we need to dial it back. Maybe we'll stay at home and just do a Caribbean cruise or something like that, for example. But we're flexible and we can make changes. And that's just helps us do our analysis based on this spending capacity. I think it's very interesting. So when I look at our income and I look at clients' income, we go through these different scenarios and people say, okay, I'm okay with that number. I understand what that means. And they move forward. So instead of a probability of success, we have this number and we say, hey, listen, we're watching it, we're watching everything. And when you hit a guardrail, a lower guardrail, then you're going to decrease. Or if you hit an upper guardrail, will increase. So I think that's probably a good place to end on this Income Lab demonstration. Again, I think the software is really quite amazing. There's way more to it than this, but this is I think the first good way to look at first good demo of how this works. Thanks, and we'll see you on the next videos.